trust issues. Well, it's something that we deal with in many aspects in our life, and in commerce, we kind of found a solution, which until today we still use, and that's through a middleman. Someone that we both trust, me and you. So for instance, if I want to give you $100, then we both trust my bank or my credit card company that I do have $100 or more, right? And let's say that he's the single source of truth. Whatever he says, we both believe. And that's for payment. So that's how we solve the payment trust problem. Same way for Amazon gift cards. If I want to give you, then Amazon is the only source of truth about it. And it's same if I buy a stock of Apple. I'm literally putting my faith in someone who will write that Ori has one stock of Apple. And over here basically comes the blockchain, comes the cryptocurrencies. They actually take that fact that is recorded only at a single institution and distributes it among many computers, I could say random computers. And once the question has been asked, right, if I want to give you $100, is the deal kosher? Then we'll kind of make a consensus between all those computers who have this piece of information about my possession, and we will agree about my amount of possession. And what happens is each one of those computers needs to prove that he could participate. And the way they prove it is by proof of protocol or cryptography algorithms. And that's actually the diversity between the groups of coins. So we have Bitcoin, which is based on proof of work, Ethereum, proof of stake. Those are cryptography algorithms. Decker, proof of activity. Ripple, which, by the way, side comment, it's kind of not exactly decentralized because the computers, the random computers, are actually all theirs. So it's kind of not decentralized. But what I'm trying to say is once you possess one of those coins, then you're actually implying on yourself all the vulnerabilities of those protocols, right? So if someone kind of sabotage the protocol or can bypass it in a way, then your capital, which is cryptocurrency, is at direct risk. So we don't have much what to do about it, but we should be aware of it and take it in our consideration. That's a very unique thing about trading cryptocurrencies and something that we should all the time monitor and understand our risks. The second thing is the ledgers, the wallet. So, okay, we have this piece of information at several computers that I have $100. And then comes the question, wait, how do they know that those $100 are mine? Like, what's the connection? So the most intuitive answer is it has a name next to it, right? Like $100, Ori. So almost it's a key, which that key actually gives me the access to change that fact, okay? To bring, to upload a request to change that fact that I have $100. So I think you already understand that this key is kind of valuable, right? It could represent an access to all your capital by just some digits in letters. And another main challenge when you trade cryptocurrencies is how you secure that key, right? Where do you put it? How do you store it? How do you manage it? We have I'll start from the bottom. In general, we have two kinds of wallets, ledgers. We have hot wallets and cold wallets, which refers if you have a door to the outer world. If it's hot wallet, then there is a door, and if it's cold, then it's actually closed. So the first intuitive thing, okay, well, I have something that it's important to remember, let's write it on a paper. Then you could store your key on a paper. It has pros and cons, of course, each method. A hardware, which you'll just put it inside, encrypted, and once you connect it, you're becoming, let's say, a hot wallet. And desktop and mobile, which could be both. It depends on the connectivity, on if the Bluetooth is on and the Wi-Fi is on of my computer, so I have different security issues. And if it's off, then same way. And the last part is you could literally give the key to a third party. It could be an exchange, and they will have the access to change that fact. Which again has its pros and cons, but those in general two, I think, quite unique things when you trade cryptocurrency that you need to really master. Volatility. Well, I think that's after you trade crypto, or you're just looking at the charts for the first or second time, it's just mind-blowing to see those candlesticks, huge one, red, green, and you very fast feel the volatility by being happy and sad in 30 minutes. So it's something special. And the more interesting thing is what makes it so volatile, the market. So first of all, and I think most of you already guessed, it's regulation. So right now, before that, there is like a sentence on regulation that I really like, which says regulation helps you. It's good, but it's slow and it's going to hurt, and I totally relate with it, but I can't really blame them for being slow because of the pace of the change at the technology. So basically, a regulator takes something new and tries to imply on it a legal and financial framework that already exists with, of course, some adjustments. So at the beginning, Satoshi Nakamoto, the guy, group, something, who invented the Bitcoin, did it with a purpose to solve the payment problem. Well, down the road, it became bigger, and the regulator said, okay, so how do we deal with it? Well, it's aiming to be a currency, then let's see how the currency regulation could apply on it. But then came this guy, Vitalik, who was actually the one who invented Ethereum, and he came from an other perspective. He said, wait, if we could solve like that the trust issue and payment, why don't we solve it on utility? So that really confused the regulator, right? So they already thought that they have something in their pocket, and then wait, so cryptocurrencies is not just for payments, so it could be for utility. Interesting. We made it a bit more complicated the last year when security tokens came out, which actually represent the possession of a stock or anything that you could possess that gives you value. We could see that the kind of evolution that we had there, and basically it creates a lot of mess in the market. A lot of large investors have a problem to trust, and it's very reasonable. And the regulation kind of took the position of, like what's going on today, just in a brief, they kind of took the position of do no harm, which I have to say it's kind of nice, because the internet at the beginning of its days, they took the exact same approach towards it. Do no harm basically means that it's still a small market, it doesn't do that much impact on the economy. Let's just wait until it figures itself out, and then we'll enter. Another thing that, of course, impacts the volatility of the market is the liquidity. So liquidity is basically like let's say the degree that you could buy or sell something without the influence on the price, right? So in cryptocurrency, if you trade it, or if you hypothetically will try to trade $10 million, you'll see that you're gonna do impact on most of the coins, and that's very different from if you wanna buy with $10 million euro, where you probably are a mouse among the elephants. Two things that make it so volatile because of the liquidity. The first one is the banks, which, because of the regulation, which there is no, they kind of made themselves their own internal policy, which is quite reasonable, and they're making a bit of a hard time to convert fiat to cryptocurrencies. The second one is actually the utility, which is the next point. About 150 years ago, there was the free banking period, which every bank could come and literally initial their own coin. So it's not new, quite not new what's going on over here. They tried it, and very fast all the value of those coins decreased to none. Why? Because there was no value, okay? There was no utility. And once there is no utility, and you only possess something in order to, let's say, get a good return on it, then there is kind of volatility, because cryptocurrency weren't meant for it in the core of it. So that's another thing that creates a lot of volatility, because people use utility coins, for instance, and they just buy and sell it because they don't have really a way to use it for today, paying for compute power, for instance. Inexperienced investors, I would say not inexperienced, but more non-credited investors, which basically means that a lot of money is poured inside the market, which is money that people cannot afford to lose. And I guess I'm not saying here's something new, but when that's happened, so people get the sense of doing the exact opposite things, and they act very irrational from our perspective, of course, and it creates quite a volatility. The last thing is short history. Well, it makes you feel good, except the fact of how it helps us to do machine learning upon it and to apply a lot of techniques, but it helps us, first of all, in our personal way to know that if now a coin just decreased 20% in a day, that I could look on the past 4 years and find at least 40 occasions similar, and I could have some optimistic approach towards it. So it's something that we don't have, and it's very hard to gather it because it doesn't literally exist. So volatility. Now let's get back to the chart and try to tackle some different approaches to those dilemmas. So for instance, if you want a minimum security, which is something you probably won't want, but it's because you want a minimum volatility exposure to the market, then you will probably use a wallet which is a third-party wallet, probably an exchange, which will give you a fast time to action, right? So for instance, if you have an indicator which indicates a change at the price, doesn't matter now how, technical, sentiment, and you want to make an action according to it, then it will be very fast because it's all in the same place. Usually I have to say that most of the exchanges nowadays are centralized, which means the transactions are made inside. It's kind of ironic that a decentralized economy is still in the centralized exchanges, but it does goes to a way, I don't know if you know, there are a lot of new exchanges who aim to be decentralized, and that will be very good. The cost, of course, is low. The only cost is the fees. If you want a medium security and the medium volatility, then you probably use a private online device, which could be a computer or a phone, as we said before. The time to make the action, though, will be medium. Why? Because you, as the one who possesses the cryptocurrency, is also responsible to move the cryptocurrency to the exchange in order to implement your strategy. So it will take some more time, and of course, it will cost. Those computers who says kosher, 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 their incentive is the fees in most of the protocols. Maximum security, maximum volatility, then you'll probably use a cold wallet, which is not connected. The time to make an action will be a lot more longer because literally someone will need to plug the USB or to enter from the paper the key before you can actually create a transfer request to the exchange, which kind of kills the whole autonomous process if that's what you're aiming to. Before I wrap up, let's just do a zoom in into the orange one and try to understand what is medium and medium. So in general, that's the traditional approach, right? You have an action indicator, something that tells you, listen, you need to buy or sell now. You go to the broker and you will probably buy or sell at the price that you meant to buy or sell. In cryptocurrency, it's a little bit different. So the action indicator, I'm not gonna get into it again, but let's take, for instance, an example that you wanna buy Ethereum with Bitcoin. So you have now the fact that you have one Bitcoin and that's in a ledger, right? In your ledger and distributed among other computers, then you need to request a transfer. But because of that, because of the problem of the liquidity, you will need to allocate your assets very, very good if you don't want to get hit by the spread. And that means, I have to say that over here it requires, the more finesse you will have over here, you could save a lot of money, and I mean a lot by, could be like 3 times less if you do it right. So you literally need to compute the transfer of the funds, to allocate it to different exchanges, then to buy or sell, which over there I could tell you from experience with less money than $10 million that you will have to follow a clear strategy because you will just kill the order book over there and the price will go up, will increase. And after all of that, you're responsible to transfer it to another ledger which holds your Ether. So you can see that there are more and new challenges over here, which we, an AltCoin consultant, took those two things very seriously, and we pay attention to them and study them and try to master them. I have to say that what gives us the motivation to keep going before that is something that our CTO said at the beginning, that, okay, we have a lot of obstacles, but in a transparent ecosystem, and it is very transparent compared to other markets, one can invest smarter,